Welcome back. Busy morning this morning. There are new China trade tensions this morning, and that is impacting futures. We're looking at a triple-digit decline at the start of trading this morning. The Dow poised to open down 106 points after President Trump cast a shadow on a potential trade agreement with Beijing before that December 15th deadline, weighing in ahead of the NATO summit in London this morning. Watch this.
The China trade deal is dependent on one thing. Do I want to make it? Because we're doing very well with China right now. And we can do even better with a flick of a pen. And China's paying for it. In some ways, I like the idea of waiting till after the election for the China deal. But they want to make a deal now, and we'll see whether or not the deal's going to be right. It's got to be right.
Joining us right now to talk through that is the Wells Fargo Investment Institute president, Darrell Cronk. Darrell, it's always a pleasure to see you. Thanks for being here. How did you read that?
So I actually took it as a pretty much market negative, straight up, just as the futures reacted. Certainly, it puts the December 15th tariffs full scale right in the square of getting enacted, along with the Brazil, Argentina tariffs, potential French tariffs. It really starts to impact how you think about 2020 and into the next year.
Why are markets as strong as they are this year with this uncertainty? I mean, aren't we talking about like 100 new highs or something for the Dow Industrial so far this year?
You are, and I think overall the economy has kind of weathered this, notwithstanding everything else. We're putting out today our 2020 outlook. We call it a call for resilience, and resilience, I think, is the key word. The markets have been unbelievably resilient. I think the real key for next year, though, is we've got to see economic growth reaccelerate, and we've got to see earnings growth reaccelerate, both of which are wild cards right now, and I think the news of this morning didn't help that matter materially.
But when you say reaccelerate, we're getting something like 2% growth in the second half of the year at an annual rate. Are you saying it's got to be faster to keep these markets going, or would a 2% year be enough to keep the economy going, the markets going higher in 2020?
I think 2% would be sustainable, John. I mean, you got to remember, 2018 we were 2.9, so call it 3. We decelerated to, we're probably going to finish this year about 2.2, so just above 2. We expect next year to be 1.8. Right? So you get below 2 and you start to approach that kind of stall speed where any kind of exogenous shock becomes material for the economy and starts to reignite this conversation we had through the summer months about recession, right?
One thing that we didn't mention is the Federal Reserve, and the Federal Reserve cutting interest rates 3 times this year is expanding the balance sheet, although, again, the Fed says they're not doing it to stimulate the economy. But at what point, because the Fed is very wary about cutting again, that's the posture going into 2020. At what point does the market stop feeling the juice from the central bank and feeling the love, so to speak?
Well, so far we haven't seen those 3 cuts completely filter through into the economic data yet. It's not unusual at all for that to take 6 months from the time of the last cut. But we do think that the bias is still probably for another cut, certainly before another hike. And so if you get first half of the year, and a lot of the economists in the baseline suggest the first half of the year looks more like a 1.3, 1.4 GDP in Q1 and Q2, and then picking up in the back half to get you to that 1.8 for the full year. Yeah. If you get kind of that really slow first half growth, I think the Fed becomes a question again about whether they can cut.
Well, I want to just talk to you about manufacturing, because you mentioned the PMIs yesterday, dragging down the markets. We had sluggish manufacturing numbers. The Institute for Supply Management Manufacturing Index down to 48.1 in November. That is the 4th straight sub-50 reading, pointing to a contraction. And we know that above 50 is expansion, below 50 is contraction. Did that bother you? I want to know what you think about purchasing managers and manufacturing. I do have this report that I've been talking about a lot from Cornerstone Macro that they think PMIs are bottoming right now. Yeah. What do you think?
We tend to agree with that, actually. It looks like the data shows manufacturing, which has, for all intents and purposes, been in a recession for all of 2019 already, right? It's the strength of the consumer and the rest of the economy that's been chugging along nicely. But it looks like manufacturing is starting to put a bottom in here, and you might actually see better results as we get ready to turn the calendar of the year, which is a positive,
but
a very strong
mentioned
positive.
Recession. You just a second ago you said, well, all of these unknowns bring us back to the conversation of recession.
I think it's a dichotomy of, you actually are probably seeing, when you think about consumer spending, which is 70% of the economy, and manufacturing, which is, call it 25 to 30%. Manufacturing looks like it's bottom and may slightly reaccelerate, but the consumer spending numbers are coming down, right? Mid-year, we were running about 4.2% in consumer spending. In the fourth quarter here, we're probably down to 2.5, maybe closer to 2.
Well, that's a concern. Go ahead, Chris. Sorry.
No, I was just going to ask. I mean, with the markets are emotional, right, Darrell? And so they respond to turmoil and all the things that are going on. All the talk right now about tariffs and all the trade battles, that creates turmoil. So what's your advice to investors out there?
Well, we actually think the economy still sustains recovery in 2020. We don't think recession is the base case. Obviously, this morning's news increases the risk a little bit of that. We've got in our outlook 3 C's that we think are really important for 2020. One is consumer, right? The consumer has to keep spending, which we're talking about right now. The second is we think you should keep your eyes very closely on credit spreads, because if credit spreads start to widen out, we think that will press the economy. We're already seeing that in the triple C's. Matter of fact, I looked yesterday, the triple C's are now wider today than they were during the fourth quarter sell-off of last year when the market was strained, even though the market's setting all-time highs.
What does that mean when you say triple C's? Break that down.
I'm sorry.
People.
Yeah, so triple C's are your lowest tier credit rating, so it's kind of your junkiest credit.
What's the signal that that's sending?
So when the credit spreads widen out, it starts to show that there's probably stress there, and that they're not priced maybe appropriately, and so you're going to start seeing deterioration in those credits, delinquencies going up, perhaps defaults going up.
There's a lot of corporate debt out there. You're saying this could be a sign that some companies are starting to get squeezed by it.
It's one of the signs we watch. We have probably about 8 or 9 indicators that we watch for kind of cracks in the ice,
So what's
early
your third
signals.
C?
The third C is China, of course,
okay.
right?
Yeah.
So you've got to see, we don't think you have to see complete de-escalation of China. We just think you can't see re-escalation of China. And this morning puts that into question.
But what about the shopping numbers that we've been seeing? Cyber Monday, we saw record numbers of people show up yesterday because of some deals. The online spending spree led to $9.2 billion in sales, according to Adobe Analytics. Darrell, that's on top of a great weekend in terms of the Black Friday numbers and the holiday shopping. So you say that the consumer is weakening. It didn't look like that this weekend.
Well, we'll see when the whole season kind of unfolds, right? I mean, so if you looked at Black Friday unto itself in a vacuum, foot traffic was down about 3 to 4%, depending on which measure you want to measure. Some were as high as down 6%. Cyber Monday up 15 to 20%. So that switch in the omni-channel is happening at a robust level. But overall expectations are still for a weaker holiday season, right? You got a shortened calendar. The weather didn't help us particularly over the weekend with storms rolling across the country. So we'll see if the consumer shows up robustly and spends.
Consumers keep spending if jobs keep coming.
That's right. You're right, John.
We got a jobs report on Friday.
Good point.
What are you expecting?
I think you'll starting to see a little bit of weakness there, probably somewhere around a 150, 160 in jobs creation, which is good.
150, 160. I think you said yesterday it was 187. Right?
Yeah, our estimate that we're going with is 180, but the estimate range is high as 237,000 jobs
You're down
added.
to 150.
Yeah. We think it's probably lower. You still got some residual effects from the UAW strike that's filtering through. So, it's enough to keep up with population growth, but labor's not going to be as strong as it's been the last couple of years. It's a quintessential late cycle indicator that the job growth does slow. The unemployment rate at 3.6% is just going to hit a cap where it's going to get constrained at some point.
It's an awfully good number, though, 3.6%.
It's a very good number.
If you stay at 3.6%, there's a lot of happy people out there.
It's a 50-year low on unemployment, right? And and last month, don't negate the fact that last month we set a new all-time high on